Bam!
Ta-da! There he is.
All sorts of stuff. We got the camera equipment all over the place. I feel like this room, every time I go to use this room, somebody on my team completely disarrays our recording room. I'm like, oh my gosh, I got to re-clean everything up, and I don't have time to do it.
I understand that. That's like when the boys get in and play on my computer. It's like, what'd you do? Yeah. Good morning, everyone. We survived the hurricane. First off, we'd like to wish everyone out there who's still struggling. We wish you the best. Need any help? Always reach out. We're here to help. But it was quite the mess left over from the hurricane. So
yep, it has been interesting to say the least, right?
Yeah.
It's every time this happens, it's always crazy to see how one street can look like nothing happened, and the next street over can you see how powerful the storm was.
Yeah. We were very fortunate that we're up on the hill because I'm along the Little Wekiva, and for the first time in a hurricane history that we can remember, several of the houses along the river actually got flooded. So did some major damage down the road, but it was nice to see everybody get out together and help everybody clean up and try and get everybody's lives back together. Yep. So, well, let's get into what's going on, because while the hurricane was going, things were still changing out there in the market. We saw rates take another jump. We saw the Treasury bill jump up to nearly 4%. Has done a little bit of a pullback. This morning, I guess, kind of opened to the negative, but we're seeing a lot of things that are affecting, and what we thought maybe might happen in January, we're seeing a lot of people throw up the flag right now of should the Fed pivot. And I didn't think they would do it this early, but there's a lot of things going on that may make them do it. I'm hoping that at least will help maybe the rates stabilize again. So, but I've seen probably 5 or 6 articles in the past week asking if the Fed will pivot, which I didn't think they would do maybe till January, February. But some people are suggesting that the next 2 meetings, they got 2 meetings left or 1 meeting left? 2, right?
2, I believe. Yeah.
Okay. Where they were talking at increases again of maybe not doing increases.
Yeah. And you saw that the Feds had that nice little special meeting unannounced where they haven't really said anything. So they kind of snuck in that one.
And the things that you're seeing going on around the world that are actually affecting the dollar is Japan has started selling off dollar assets to support their currency.
Yep.
Europe, they increased. They actually went back to quantitative easing.
Yep.
Britain bought some bonds and then stopped. They went through like 3 or 4 days of buying. Their central bank bought bonds and then they just stopped. And they said it was strictly to stop a run, basically, on the bank.
Yeah.
And then China, I think it was on Friday, announced that they're going to start selling off dollars to support their currency.
Yeah.
So now, all of a sudden, you've got all these dollars coming back into the market. And when they come back into the market, what does that naturally do? Increases the yields that are necessary to resell the money. So that's a major factor. But then we got hit with this morning. OPEC is going to cut production of nearly 2 million barrels a day. So it's like, okay, so we got the dollars coming out. We got OPEC cutting production, which will mean for us gas prices going up again.
Yep.
So inflation goes up again.
Yep. It's been, I will say, I laugh with this because I was talking to my team, and we do a bi-weekly team like company meeting. And I used to just talk to my LOs about what's happening in the market. And now I talk to our entire team because I was like, you guys really need to know, even if you're in non-producing positions, what's really going on. And I made a joke this past week, and I was like, the funny part is 4 years ago, I tried to have a weekly or a bi-weekly update on what's going on in the markets. And it was so boring 5 years ago because it was like, well, nothing's changed.
Yeah.
Rates are this. And it's like, you think about it, and we think about those days, like, and yeah, I'm sure you remember this. We used to sit there. We would not even have to go into our pricing engine. We wouldn't even have to look at lenders and investors. We could be like, well, an FHA is going to be your 640 credit score. That's going to be a 3.5. We'll be able to give you $5,000 in lend credit there. And it's like, we didn't even have to price it up because we had priced it up so many times and it didn't change over months and months and months that it just, you were able to. Now it's like the market, like, on Tuesday, I was like, oh, we're getting a little bit of a reprieve. Rates are starting to drop. Wednesday, I'm like, wait, what happened? Rates are back up. Like, I'm like, wait, everything that happened on Monday that caused Tuesday, and then nothing happens on Tuesday, but now Wednesday responds completely negative. And, I was all excited. On Tuesday, they were like, oh, prevailing rate on conventional, according to Mortgage News Daily, was like 6.6. But then, and that was for Tuesday. And then Wednesday, so today I look at the report. So at the end of yesterday, it's 6.95. I'm like, wait a minute. What happened yesterday that we lost 3?
I didn't hear anything. Yeah.
And that's the part that, like, I crack up on, is it's so hard for us in the industry to really, and, you have to have these tough conversations. I was talking to a buyer right now, like this morning. She's been under contract for 60 days. They need a little more time, right? There was repairs that were being done that took a little bit longer. Hurricane happens. We got to get a re-inspection for the appraisal. No damage really, but it's kind of one of those where it's like they were supposed to close started next week, but they might need a week. And I was telling them, like, hey, the cost to extend that is about this. And they're like, well, I don't want to pay it. And I said, well, and I get it. It's like, you don't want to pay it and you don't want, but I was like, guys, like, you negotiated. Like, the seller has spent over $20,000 on repair, and it's a $500,000 house. But I'm like, that's $20,000+ in repairs. Like, I get that the seller did that, but it's like going back to the seller and being like, well, I want another $900 for this lock extension.
Yeah.
Like, well, why can't you cover? And I said, well, I had to do a 60-day. I already did a 60-day lock. I'm already giving you help. Like, I've already given you credits and else applied elsewhere. I can't keep covering everything. I was like, it's $900 on a $500,000 loan. And they were like, well, we're just going to let it cancel then. And I told them, I said, awesome. I have you at a 5.125 interest rate, and it's a VA loan, but costing nothing.
Oh my gosh.
And
run.
And I told him, I said, if you were to buy, like, if you were to cancel this, go to a new property, you want that same deal? We're going to be 6.375.
Oh yeah. Easy.
And I was like, and I said, on this same property, just that difference of rate, it's going to, that'd be $500-$600.
Yep.
And they were like, wait, what? I said, yeah, that's you're fighting over. You're willing to let this go over $900 for a property you love, and the reality is the market's changed that much. And they're like, it's only been 60 days. I said, yeah, that's how much the market's moved, though.
Yeah.
Like,
speaking of that, I actually went on and pulled this off of Mortgage News Daily because I thought that was important for us to show people that, hey, these are the actual numbers. And that is a perfect scenario. Here is August 8th. We're sitting roughly 5%.
Yeah.
On the interest
rate. Look at that. There we go. Perfect scenario. I just hit the scenario.
Yeah, you nailed it. Didn't even have time to line that up with you this morning. But you nailed it. Here's today. 7%. That is 60 days. 60 days, we've jumped 2% in interest rates.
Yeah. That's nuts.
And the problem is, I don't see anything to pull us down. There's too many factors. The dollar being so strong is destroying other currencies. So they're dumping our dollar.
Yeah.
We've still got inflation sitting high. So Powell's like, I'm not going to change. I'm not going to move.
Isn't that crazy? And this is the part that's hard to understand, because the American dollar is stronger on a worldwide level right now. It hurts us.
Yes.
Isn't that crazy? But if it was weaker on a worldwide level, it hurts us. We're in a no-win scenario right now. And I kind of joke because I'm like, is part of this because everything has been tied to the dollar for stabilizing world economies for so long that, I was looking at reports like the American dollar is so strong. Britain's having issues. China, like the value from the dollar to the Chinese yen, is at its lowest that it's ever been, apparently, right?
Yep.
So, we run into all these scenarios where you kind of go into this tough position of, well, I was talking to other, you look at it, it's like Kenya, Egypt, they're mentioning all these other countries that because of the strength of the American dollar is causing those countries to potentially default on their world debt now. And it's like, how crazy is that?
Yeah, it's a great time to be alive if you love economics. If you love economics, it's a great time to be alive, because all the rules you've ever learned don't make sense anymore. They just don't make sense anymore.
It's like the housing market a year and a half ago.
Yeah, it is. It is. I met a couple last evening who had sold their house in Miami and are renting here right now.
Yep.
And they're like, well, prices are so high. I'm like, well, we've come down a little bit.
Yeah.
But you got to remember, your interest rates are going up. So that cost of buying that home is going up. So your purchase value is going down. And they're like, what do we do? I said, well, that's a darn good question. To me, it's oh boy, you gotta. It's kind of like picking your poison. What one can you live with? Where do you sit and wait and hope they pull back more, but then have the interest rates continue to go up? So it's basically, it becomes a wash. You actually even get hurt. I've got a young couple who wants to live with his parents for like 6 months to save up money. But I'm like, guys, your interest rates are going to be here. We've got some builder incentives right now where, they're willing to buy you down to 5.25%, and where you'd be 6.75, 7% right now. That's like you said, that's $500 or $600 a month. So it's like, I take advantage of it. I quite honestly would take advantage of it.
Yeah.
If you find the house you like and they're willing to do this, but hey, you got to move in, the end of December in order to meet their incentives. But you're going to save $600 a month. Are you really going to save $600 a month living at your parents' house? Or, is it worth that?
Yeah.
Not to take advantage over here.
Yeah,
and it's crazy. It's you just look at the numbers and try and figure it out.
Yeah, I think that's the hard part is, and this is the part that's kind of a challenge, is everybody's waiting. Well, what's going to happen? Is there going to be housing collapse? Is price? Our housing, is house value going to go down? You know what? With the strength of the dollar right now, I doubt. I think we've seen what we're going to see, but we're going to see those. But you're going to see monetary policy on the Fed level adjust some. But what does it look like? The Feds right now are still trying to figure out. We saw some positive. We saw some manufacturing numbers decline, weren't as strong as they thought, which helped taper helped inflation drop a little bit, which was great. But then it's like, okay, well, then you see the world impact of, well, now the world is struggling over here, which increased the value of the dollar, which is going to hurt us anyways, and that's the crazy part is, we're in this kind of weird scenario where the world economy structure has a lasting impact on everybody.
Yeah.
And it's both, it'll help. I think what'll happen is it'll help when we see stuff. I think it'll help countries not have as bad of turmoil as they would have without this world economy, but it will also keep countries from growing as fast as it kind of levels a playing field, or kind of keeps everybody tied together. It's like we're all tied to a rope. Now.
Black Knight came out with their monthly report a couple days ago, and there were some interesting numbers in there. Let me show you these real quick. Because we talked about the price decreases, Orlando compared to everywhere else in the country. And this is an actual map of change in the median price from the peak so far this year. And what you're seeing is out west, here's Phoenix is down 6%. San Jose, California is down 13%. San Francisco is down like 13%. Oregon, I think this is Portland, Oregon here, they're down 5%. But down here, here's Orlando right here. We're sitting at roughly we're down about 2%. So we're holding fairly well. Again, it's a different market down here. And you look at Texas, which was another big market, they're only down 1%. And you look at Miami, which was the biggest booming market during.
They're neutral.
Yeah, they're neutral. They're sitting even. So, it's we're going to have a little bit of a price adjustment. That just makes sense with the rising rates. You know what I mean? But when you compare it to the other ones, San Jose down here at 13, San Francisco 10, Seattle, down 9.5, we're still good. And one of the other interesting things from the numbers that they put out here is where one of the big things that drove the crash were foreclosures. Foreclosure numbers are actually still extremely low, and delinquencies on mortgages is extremely low as well. So we're not, one of the big factors that pushed us over the edge isn't there. And that's because people are locked in at extremely good rates. When you're locked in at 2.5% on a 30-year mortgage, or 2.75 at a 30-year mortgage, it's not straining you. You're not taking that jump that all those arms had taken on everybody. But this is the major concern that I see, and this is payment to income ratio on a 30-year versus a 30-year mortgage rate. Back when we crashed, that was sitting at about 33.8%. Right now, we've jumped to 36%. That's one of the highest levels in history. So it's taking more of people's income to afford a house. So it's leaving less discretionary income. You may not be going out to eat 3 nights a week anymore. You may not take that second vacation during the year because it's going to put it, with the rates going up, it's putting more of a strain on people.
Yeah, exactly.
So, it's interesting to see some of the dynamics that are happening out there. But, when we get into the numbers here for Orlando, last week, of course, sales fell because you couldn't close for pretty much the whole week, especially if you didn't have insurance. So, they still had were able to get 293 closings in for the week, which is pretty darn good. But we saw our median price jump up just a little bit to 405. Okay. And our inventory decreased a little bit. So this is one area where we can kind of say this is getting boring and kind of nice, because our inventory is kind of leveled off. And when you look at look at our median price and average price, we're also kind of leveling off. So really, since September, average median price is sitting pretty steady. Our median price, dipped a little bit, but has come back up a little bit. So we're sitting steady there. Oops, where's our inventory? Our average days on market jumped back up a little bit. We had jumped to 35 early in the month, and we're back up to 35, but we're staying consistent there. And then our inventory is really kind of flattened out. So even though our inventory is up, we're still sitting at relatively low levels of inventories compared to compared to where we've sat previously in the past. We know there's plenty of houses. Most things staying on the market for 30 days. Buyers still aren't feeling rushed, and you're still being able to negotiate because we're still holding at that roughly 95%. See here, we're sitting really close to that 95% of original list price to sales price, and straight across the board. The 300 to 400,000, you're about 4% discount off the original sales price, and the 400 to 500 range, you're sitting at 95.19%. So there's room in there to negotiate on things that on the homes that are available out there right now. So it's consistent. The number of buyers is still, I think, relatively low compared to what we had, 6 months, 9 months ago. But the people who are looking are very serious people.
Yeah.
But it just may take us, we may work with them for 3 or 4 weeks before they find the exact home that they want. So that's one place where we are seeing consistency, and that's where you've got to go away from the 100,000 foot view down to the 100-foot view and look at each individual market and how they're adjusting and how things are playing out.
Gotcha. Yeah. It's definitely. I think that's the big key right there. Like you said, it's a small decline. There's opportunity. It's taken a little bit longer, but how much of, like, when you look at all of this, and we hear this a lot of, I'm hearing, like, is it a buyer's market now?
Again, it depends on which area you're in. Interesting enough. Like if I go to Deltona, I tell you Deltona is totally a buyer's market right now. Completely a buyer's market. Where you go to some of the newer place, some of the more, I guess, desirable areas in like Seminole County, like Oviedo.
Yeah.
Oviedo's still extremely strong.
Gotcha.
You're still seeing really Oviedo maybe about a 14-day turn time and not as much of a discount. I've got a client right now who wants to be in a certain section of Oviedo, and we're just kind of waiting for something to come on the market because people don't want to sell the houses because they love that subdivision.
Yep.
And that's a case where we're going to have to pay top dollar to get her what she wants. I think our biggest problem going forward with listings, and I think this is one reason why you've seen the number decrease, is a lot of sellers have the feeling that, the market's come down. I don't want to lose money. Well, you're still up 12.5%, 13% last year.
That's the funny part about that argument a lot is, and I do feel like I get it. What you're finding is, I think the difference is now people aren't selling that don't have to sell.
Right.
And we've never really been in an environment where people don't sell that. Like this last couple of years was kind of interesting because people were selling because it just made sense. Like, they had no reason to sell, and they were like, I'm going to cash out. Like, I've never had 300,000 in equity on something.
Yeah.
The funny part is they bought in that same market. So
Yeah. So
how much of a wash is it? But
yeah. And I think the other thing that's going to stop a lot of people from selling, and I've mentioned this numerous times, is why would I give up my 3% interest rate?
Yep.
To go to a 6.5%, 7% interest rate.
Yeah.
Even with all the equity that I could walk away with. I mean, right now I could walk away with $150,000 in equity. But with the price increases and the higher interest rates, it just doesn't make any sense.
Yeah.
So I think we're going to see a lot of people stay in their homes longer than they had previously.
Yeah. I think that average lifespan of being in the home is going to go up. I do think when it happens, I think we're probably going to be high 5s, 6s for a while. Like, I don't see us getting into 7, 8, 9s consistently. I think we're going to be touching toes with 7s for a little bit right now because of uncertainty, but I don't think long term. But I do think that 5, 6, that those are rates that I think can last and be sustained for a long time.
Yeah.
How the Fed handles this inflation piece is going to determine if we do blow 7 out the water and end up at 8 and 9, or if they get it tapered down and then, the 5, 6s become the commonplace.
Yeah.
I think that once we have more certainty over rates of where they're going to be heading long term, I think you'll see borrowers or sellers and buyers make decisions more quickly.
Yeah. Yeah. And at that 5, between that 5 and 6, it still can support the prices that we're seeing.
Yeah.
As well. When you're getting up to the 7, that's where the 7, 7.5, I think that's where you're going to see the downward pressure on home prices, strengthen even more. But if they can hold them in the 5s to 6, because we kind of saw that it took about 2-3 weeks, and then it seemed like things picked up again once everyone got used to that 5.5% interest rate. It seemed like sales picked up again.
Yeah.
So it's like you said, interesting time to be in our industry.
Yeah. Yeah.
So, all right. Well, thank you, everyone. Thank you, Joe. As always, great to see you.
Absolutely.
Take care,
you as well.
And we will chat with you later.
Sounds good.
Bye.
Rocky, guys.